Hey everyone, welcome back to Corporate Decoder, the place where we peel back the curtain on the world of big business and sometimes find a few surprises lurking beneath. So this report we're diving into today is from Actelis Networks Incorporated, and it is all about whether they are still on track to be listed on a major stock exchange called Nasdaq. Imagine your company's stock is like a ticket to a popular amusement park. This report is basically asking if Actelis still has its ticket to stay on that park's ride. Now, what does that actually mean? Well, companies that want their stocks to be traded publicly, meaning anyone can buy and sell them, have to follow certain rules. One of the big ones is making sure the company has a certain amount of value, kind of like a minimum amount of money in the bank or assets to your name. This is to protect investors. Nasdaq, a very well-known place where stocks are traded, has its own specific rules, and one of them is about something called stockholders' equity. Think of stockholders' equity as the company's net worth, what it owns, minus what it owes. Nasdaq requires companies to have at least $2.5 million in their stockholders' equity to stay listed. Actelis Networks Incorporated previously got a warning from Nasdaq. It seems they dipped below that $2.5 million stockholders' equity mark as of the 30th of June of last year. Because of this, they were put on a special kind of probation, and they had to go in front of a panel, like a review board, to explain themselves and show they had a plan to get back on track. They recently had that hearing. At this hearing, Actelis presented its plan. They essentially said, here is how we're going to fix this and make sure we meet all of Nasdaq's requirements to stay listed. The big question now is whether this panel will accept their plan. There is no guarantee, and the company itself admits they can't be sure they'll be able to show they meet all the requirements, even if the panel gives them more time. Now, to help boost that stockholders' equity and show they are serious, Actelis did a couple of things. They had a private sale of their stock, which is like selling shares directly to specific investors, not on the open market. This brought in about $850,000. On top of that, they secured something called an equity line of credit, or ELOC for short. This is like having a credit card specifically for selling stock, and they could potentially draw up to $30 million from it over 3 years. So because of this private sale and the ELOC, Actelis believes they now have enough stockholders' equity, at least $2.5 million to meet Nasdaq. S-Rule, they are waiting for Nasdaq to confirm this. However, they also wisely point out that if their next official report shows they are still not meeting this requirement, they could still be delisted, meaning their stock might stop being traded on Nasdaq. Let's look at what those registered securities are. It is their common stock, which is currently trading under the ticker symbol ASNs. On the Nasdaq capital market, this is essentially the stock that is at the heart of this Nasdaq listing issue. And here is another interesting detail. Actelis Networks Incorporated is checking the box to say they are an emerging growth company. This is a status given to younger companies that have less than a certain amount of revenue, and it allows them to have some flexibility with certain financial reporting rules. Now, looking at this from a more zoomed out perspective, this filing is essentially about Actelis trying to prove its fundamental health to Nasdaq. The core issue is their stockholders' equity, which is a key indicator that investors and exchanges look at to gauge a company's financial stability. Not having enough equity can signal that a company might be struggling or has taken on too much debt. The private placement and the equity line of credit are clear moves to shore up their financial position. They are essentially trying to buy themselves another chance at staying on Nasdaq. The success of this strategy hinges on whether Nasdaq accepts their updated equity figures and whether they can maintain that level. The risk here is pretty straightforward if they can prove compliance. Delisting from Nasdaq would make it much harder for investors to buy or sell Actelis stock, and it can significantly hurt the company's ability to raise future capital and its overall reputation. It is like moving from a major highway to a small side road, much harder to get noticed and to get where you need to go. On the flip side, if they successfully navigate this and remain listed, it shows they can manage their finances and regulations. This could build confidence with investors. However, the fact that they had to resort to these measures suggests they are facing financial pressures. The $30 million ELOC is a significant amount, and drawing from it means issuing more stock, which can dilute the value for existing shareholders. So, while it might solve an immediate problem, it could create others down the line. Overall, Actelis Networks Incorporated is in a precarious position. They've received a clear warning and are taking steps to rectify the situation. The critical factor is Nasdaq's final decision. If they falter now, it could have a substantial impact on their future. Alright, that is our breakdown of Actelis Networks Incorporated's latest filing. What is your take on these numbers and what they signal for the company? As future, do you think they will successfully remain listed on Nasdaq? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching, see you next time.